Oddly, technical analysts who try to time stock prices often focus solely on the price and forget about time. Cycles are one way to measure time and can help traders determine when to trade certain stocks. The seasonality charting tool on the thinkorswim platform is designed to help traders track how different corporate and economic cycles impact the price of the stock. We'll discuss what's driving those cycles, how to set up and use seasonality charts, and then we'll look at some specific examples. A stock's price commonly creates highs and lows over time. A cycle is the time from one low to the next low. Ideally, traders would make bullish trades on the upswings and bearish trades on the downswings. The chart lows can change depending on seasonal cycles that typically occur in a one-year time frame. For example, oil prices may tend to fall during the winter months when changes in weather might restrict travel. Construction may also tend to pick up as the weather warms. When a company announces quarterly or annual earnings, it can lead to a similar cycle. U.S. companies tend to announce earnings around the same time each quarter, which can prompt a stock to rise or fall as new information about the condition of the business is revealed. However, not every cycle has an obvious explanation or driver. Let's walk through an example of how to use the seasonality chart settings on the thinkorswim platform. Starting at the Charts tab, then click on the gear icon. Next, select the Appearance tab, click Standard to open the list, and select Seasonality. Next, we'll set parameters. The default setting shows 5 previous years of a stock's price changes, as well as the current year. You can see a 7th line that represents the average of the years by selecting Display and then clicking Yearly plus Average. Next, we'll divide the chart into 4 seasons by selecting Highlight Seasons. We'll also display earnings announcements by selecting Highlight Earnings. I'll select Apply and OK. Here's the chart. We'll use Coca-Cola as our guinea pig. As always, these examples aren't a recommendation. The seasonality chart is very busy, so let's take a minute to orient ourselves. The background has 4 colors for the 4 seasons. Winter is blue, running from December to February. The next 3 months in green are spring. Summer is in yellow, and autumn in orange. Earnings and announcements are the lighter colored columns, which can be an important time to watch changes in the price. Now, let's talk about the price lines. The short blue line is the current year. The other thin lines are the prices for the last 5 years. Using a vertical line for the pointer, you can see the years for the different lines color-coded to the labels just below the name of the stock. You can add or subtract years with the time frame setup. 3 years will be 3 lines. 10 years will be 10 lines. The fewer the lines, the less data. Increasing the number of lines could result in making the chart difficult to read. We'll stick with the default of 5 lines. The bold orange line is the composite, or average line of the last 5 years. We'll use this line to track and analyze the stock cycles. Cycles can be identified by focusing on the lows in the average line. Looking at the chart of Coca-Cola, the average line shows lows between earning announcements before rallying ahead of the releases. Of course, there's no guarantee the cycle will stay in place. What the seasonality chart shows is that Coca-Cola's stock appeared to rally through earnings, which it seems to report earnings about 2/3 of the way through each season. If a trader expected the cycle to continue, this might be the time they consider a trade. The cycle on the chart points to bullish strategies through earnings and bearish or hedging strategies not long after earnings. Of course, these cycles aren't set in stone, and as you've heard many times, past performance doesn't guarantee future performance. So use the seasonality chart in conjunction with your other analysis. There are seasonal cycles outside of earnings. Trading almanacs and tracking services analyze cycles and can be informative for anyone interested. Many traders find cycles in commodities. However, the cycles a commodity stock faces may be different than the commodity itself because there are other influences like the cost of harvesting, processing, and transporting, plus how effective management is at managing these costs. With oil, the Stock Trader's Almanac states that prices tend to bottom out in February and top out in October. We'll use ExxonMobil for this example. The cycle is likely driven by the summer travel season, particularly in North America where demand is highest. When school is back in session and weather turns cold, vehicle use slows down. Demand for oil products like gasoline falls, and oil prices fall, which often drags down the price of Exxon. Looking at the chart, we see Exxon does not show the same up and down cycles around earnings as Coca-Cola. Instead, the average line bottomed out in January and peaked in November. So during the upcycle, a trader could consider bullish strategies. During the down cycle, traders may consider bearish or hedging strategies. Of course, market conditions do affect these cycles. Notice the light blue line, which is the price action for 2026. Exxon grew at a fast rate even during the down part of the cycle. The stock price rallied along with oil prices when the US and Israel went to war with Iran. It caused concern around Middle Eastern oil supplies and shipping routes. Some sectors and industry group cycles don't relate to earnings or commodities. Like I said before, not all cycles have an obvious driver. Let's do a quick rundown of a few. Historically, healthcare stocks tended to be strongest from July through September, which may be driven by major medical conferences during the spring and fall months. Knowing this, we could examine a stock like United Healthcare. The seasonality chart shows that over the last 5 years, United appears to bottom in June and weakens in November. United's cycle may just be a little different than the rest of its sector, or the cycle may have expanded in recent years. In the past, technology stocks were strongest between January and April, which may be driven by new products and mid-year earnings reports. But over the last 5 years, Microsoft has been stronger from March to July, and then October to December. Construction materials have historically been strong from March to September, which could correspond with weather-related construction. Vulcan Materials bottomed out in March and topped in August. However, it has also shown strength at the end of the year. A trader expecting cycles to continue could employ bullish strategies during the upcycle. So when you learn about a cycle, you can grab a related stock or ETF and put it in the seasonality chart to see if it stacks up with recent history. Then consider which strategies may be best depending on current market conditions and where the stock is in its cycle. While cycles may seem obvious at times, they can change due to market news, which may cause them to expand, contract, or even truncate. The seasonality chart can help traders identify and evaluate these cycles and have more information to help determine which strategy best fits the environment. Learn more about technical analysis by visiting our YouTube channel or go to schwab.com/learn.